What the market did not see was how closely linked these entities had become. Behind the image of a neutral exchange was a trading firm whose role the market misunderstood. Alameda Research was described as an independent liquidity provider, a common feature in exchanges. What made it different was not its function, but how closely it was tied to FTX itself. FTX and Alameda shared origins, leadership, and operational proximity. This created an incentive structure that was fundamentally asymmetric. Alameda was not simply another customer subject to the same constraints as everyone else. It was deeply embedded in the ecosystem that FTX controlled. Over time, this proximity turned into dependency. Alameda relied on FTX as its primary source of liquidity, execution, and capital flexibility. What the market did not see was how closely linked these entities had become. Instead of operating as separate risk-bearing firms, they functioned as interconnected balance sheets. Alameda's trading depended on capital access controlled by FTX, weakening the constraints that normally force losses to be absorbed or activity to stop. This dependency mattered because exchanges occupy a position of structural trust. Users deposit assets assuming the exchange is neutral and insulated from proprietary risk. Once an exchange becomes financially entangled with a trading firm, that neutrality erodes and the exchange begins to absorb risks it was never meant to carry. When trust-based systems encounter stress, hidden dependencies surface abruptly. Alameda was not a side story to FTX's collapse. It was the mechanism through which internal losses became an existential threat to the exchange itself.